We're going to look now at recording inventory transactions. A perpetual inventory system involves recording inventory purchases and sales on a perpetual or continual basis. This information will affect decisions related to purchase orders, pricing, product development, and employee management. Because these decisions need to be made on a daily basis, maintaining inventory records on a continual basis is necessary. A periodic inventory system does not continually record inventory amounts. Instead, it calculates the balance of inventory once per period at the end, based on a physical count of inventory on hand. Because the periodic system does not provide a useful continuing record of inventory, very few companies really use the periodic inventory system in practice to record inventory transactions. In this section here, we're going to focus on how to record inventory transactions using the perpetual system. So this will cover using the perpetual system. Here are the inventory transactions of Mario's Game Shop from January 1st through December 31st. Note that Mario starts the year with 100 units of inventory. It previously purchased at $7 each, or a total of $700. During the year, Mario's had 2 purchases and 2 sales. On the following slides, we're going to see how to record those purchases and sales at the time they occurred. So to record the purchase of new inventory, we debit inventory, an asset, to show that the company's balance of this asset account has increased. At the same time, if the purchase was paid in cash, we credit cash, or more likely, if the company made the purchase on account, we credit accounts payable, increasing total liabilities. This entry shows how Mario records the purchase of 300 units for $2,700 on April 25th. We make 2 entries to record the sale. The first entry shows an increase to the asset account, in this case accounts receivable, and an increase to sales revenue. The second entry reduces the inventory account as it records cost of goods sold. This entry shows how Mario records revenue of $4,500 from the July 17th sale. We assume that Mario's Game Shop uses FIFO and calculate the cost of the first 300 units purchased as $2,500, which is $700 of beginning inventory, the 100 units at 7, plus $1,800 of the April 25th purchase, 200 units at 9. Now we record this amount as the cost of goods sold for the July 17th sale. At the same time, we maintain a continual, which perpetual method, record of inventory by reducing the inventory balance by the cost of the amount sold, which is $2,500 as shown here. For the entire year, Mario has 2 purchases and 2 sales. The cost of the purchases adds to the beginning balance of inventory. The sales reduce the balance of inventory for the cost of the inventory sold. The cost of the inventory sold is assumed to be the first inventory purchased, FIFO. After recording all purchases and sales of inventory for the year, we can determine the ending balance of inventory by examining the postings to the account. Now, Mario's ending balance is $2,200. In practice, virtually all companies maintain their own inventory records using the FIFO assumption because that's how they typically sell their actual inventory. However, as we talked about earlier, for preparing financial statements, many companies choose to report their inventory using LIFO. The adjustment to report inventory using the LIFO assumption is referred to as the LIFO adjustment. This involves a very simple adjusting entry at the end of the year. Here's a summary of the inventory account for Mario's game shop after the LIFO adjustment. Mario's ending balance of inventory using a FIFO is $2,200. Under LIFO, it is only $1,600. If Mario wants to adjust its FIFO inventory records to LIFO for preparing financial statements, it needs to adjust inventory downwards by $600, decreasing the balance from $2,200 to $600. We do this LIFO adjustment at the end of the period through a decrease to inventory and an increase to cost of goods sold. Let's talk about 3 additional inventory topics. Freight charges. A significant cost associated with inventory for most merchandising companies includes freight, which is also called shipping or delivery charges. This includes the cost of shipments of inventory from suppliers as well as the cost of shipments to customers. Freight charges on incoming shipments from suppliers are commonly referred to as freight in, and we add the cost of freight into the balance of inventory because the cost of freight is considered a cost of the purchased inventory. Later, when that inventory is sold, those freight charges become part of the cost of goods sold. The cost of freight on shipments to customers is called freight out. Shipping charges for outgoing inventory are reported in the income statement either as part of cost of goods sold or as an operating expense, usually among selling expenses. Purchase discounts. As we talked about in the previous chapter, sellers often encourage prompt payment by offering discounts to buyers. From the seller's point of view, these are sales discounts. From the buyer's point of view, they're purchase discounts. Purchase discounts allow buyers to trim a portion of the cost of the purchase in exchange for payment within a certain period of time. Buyers are not required to take purchase discounts, but many find it advantageous to do so. Purchase returns are when returning inventory items that are unacceptable for some reason are referred to as purchase returns. The purchase return is recorded as a reduction in both inventory and in accounts payable. Recall that Mario's purchased inventory on April 25th. Now the purchase was 300 units at $9 each. What if the purchased inventory was being shipped and it took 4 days for the physical inventory to be delivered from the supplier to arrive at Mario's on April 29th? When does Mario record the purchase of the inventory? Is it April 25th or April 29th? The answer depends on the shipping terms associated with the purchase. When goods are shipped, they're shipped with terms FOB shipping point or FOB destination. FOB stands for free on board and indicates when title passes from the seller to the buyer or ownership passes from the seller to the buyer. FOB shipping point means the title passes when the seller ships the inventory, not when the buyer receives it. In this case, Mario would record the purchase on April 25th. In contrast, if the seller ships the inventory FOB destination, then title transfers to the buyer when the inventory reaches its destination, and Mario would record the purchase on April 29th. Here's an illustration of how Amazon accounts for various shipping costs. As you see here, cost of sales consists of the purchase price of consumer products and inbound and outbound shipping costs. Outbound shipping costs net of shipping revenue in 2014 was $4.2 billion, 2013 $3.5 billion, and 2012 $2.9 billion. My guess is it's not as though shipping costs have increased, it just shows their sales have increased significantly. Here's a question for you. Which of the following transactions would increase the balance of the inventory account for a company using the Perpetual inventory system? A. Costs of incoming freight charges on merchandise inventory. B. A return of damaged inventory to the vendor. C. A purchase discount taken for prompt payment. Or D. Shipping charges for outgoing inventory. Cost of incoming freight charges on merchandise inventory would increase the balance of the inventory account. Returns of inventory would decrease the account balance, as would a purchase discount given for prompt payment. Let's take a look at what happened to gross profit after accounting for the additional inventory transactions related to freight charges and the purchase discount. Notice that the cost of inventory sold increases for the amount of freight charges and decreases for purchase discounts. For every purchase transaction, there is a sales transaction for another party. Sometimes seeing the other side of the transaction helps us understand the economic events we're recording. Camcorder Central, the purchaser, made a $52,500 purchase on account from Sony, the seller. For Camcorder Central, the purchase on account is made for $52,500, and Sony records the corresponding sale on account for $52,500. Camcorder Central then returned inventory of $2,500 to Sony. This means that Camcorder Central has a purchase return that's recorded as a reduction to inventory, and Sony has a sales return of $2,500. Finally, Camcorder Central received a $1,000 purchase discount for quick payment. This means that Sony would also need to record a sales discount for $1,000. Let's take a look at exercise 11 and 12. DS Unlimited has the following transactions during August. On August 6, purchases 70 handheld game devices on account from Game Girl for $200 each, terms 110 net 60. Now remember, 110 net 60 means if it's paid within 10 days, it's a 1% discount. Otherwise, they pay the net amount in 60 days. On August 7th, pays $400 to Sure Shipping for freight charges associated with the August 6th purchase. August 10th, returns to Game Girl 6 game devices that were defective. August 14th, pays the full amount due to Game Girl. August 23rd, sells 50 game devices purchased on August 6th for $220 each to customers on account. The total cost of the 50 game devices sold is $10,212.59. So we're going to record the transactions of DS Unlimited, assuming the company uses a Perpetual inventory system. So as you see here, This slide shows the various transactions using the Perpetual system. The first, where it shows purchases 70 handheld game devices for $200 each. We show inventory of $14,000 and accounts payable of $14,000. Then when we pay for the freight, we increase our inventory of $400 and we credit cash for $400. Then we return the defective inventory, so we debit our accounts payable because we no longer owe them on the defective merchandise we're returning for $1,200, and we credit our inventory for $1,200. Then we pay on account with a 1% discount, so the 1% discount is going to save us $128. So as you see here, we are going to debit the full amount of our accounts payable. We are going to credit $128 from inventory because we are reducing the cost of our inventory by $128 because we are paying early, and we are crediting our cash of $12,672. Then on August 23rd, we are selling more inventory, so we debit accounts receivable for $11,000, we credit our sales revenue, and then we show the debit to cost of goods sold of $10,212.50, and we reduce our inventory by the same amount because now it is an expense of $10,212.50, recording the cost of inventory sold. Now, exercise 612 basically takes the same information. Prepare the transactions for Game Girl, assuming the company uses a perpetual inventory system. Assume the 70 game devices sold on August 6 to DS Limited had a cost to Game Girl of $180 each. The items returned on August 10th were considered worthless to Game Girl and were discarded. So as you see, we would debit accounts receivable for $14,000 and credit sales revenue for $14,000. We also need to report the inventory that we sold. So we would debit our cost of goods sold for $12,600 because the 70 game devices had a cost of $180 each. We would credit our inventory for the same amount, $12,600. Regarding the sales returns, we would debit sales returns for $1,200 and credit accounts receivable for $1,200. When we received the cash, we would debit the cash for $12,672. We would debit a sales discount of $128 and credit the full amount of accounts receivable of $12,800. Next, we're going to look at the lower of cost and net realizable value. Companies sometimes have old inventory that has fallen below its original cost. In those cases, should the inventory be reported at the reduced value or the original cost? We're going to look at that. So we're going to talk about how we go about applying the lower of cost and net realizable value rule for inventories. When the value of inventory falls below its original cost, companies are required to report inventory at the lower net realizable value of that inventory. Net realizable value is the estimated selling price of the inventory in the ordinary course of business, less any costs of completion, disposal, and transportation. In other words, it's the net amount a company expects to realize in cash from the sale of inventory. Once both the cost and the net realizable value of inventory are determined, the company reports ending inventory in the balance sheet at the lower of the two amounts. This is known as the lower of cost and net realizable value. Assume Mario's Game Shop sells Fun Station 2 and Fun Station 3. This slide provides information related to ending inventory at the end of the year. Mario reports the Fun Station 2 and ending inventory at net realizable value of $200 a unit because that's lower than its original cost of $300 a unit. The 15 Fun Station 2s were originally reported in inventory at their cost of $4,500, which would be 15 at $300. To reduce the inventory from that original cost of $4,500 to its lower net realizable value of $3,000, which is 15 times 200, Mario has to record a $1,500 reduction in inventory with a year-end adjustment to cost of goods sold and inventory. At the end of the year, a company reports the following inventory amounts. So item A, we have 100 units at $4 and the net realizable value there is 8. Item B, we have 150 units, the cost is $8, the net realizable value is 6. The amount to report for ending inventory using the lower of cost and net realizable value is going to be A, 1,600, B, 1,700, C, 2,000, and D, 1,300. So we're going to take, for item A, the $4 a unit is the lower of cost or net realizable value. Item B is going to be the $6 per unit. So we've got 100 units at 4 and 150 units at 6 to give us the $1,300. Here's another one. At the end of the year, a company reports the following inventory amounts. Unit A has, or item A has 100 units. Cost is 4, net realizable value is 8. Item B, 150 units. Cost is 8, net realizable value 6. The year-end adjustment using the lower of cost and net realizable value would include A, a credit to inventory for 300, B, a debit to cost of goods sold for 400, C, a debit to inventory for 500, or D, a credit to cost of goods sold for 700. The recorded cost of inventory would be 100 units at 4 plus 150 units at 8. The lower of cost and net realizable value is 1,300. So the year-end adjustment would be $300. We would adjust our cost of goods sold, debit that, credit our inventory for $300. Let's look at exercise 614. A company like Golf USA that sells golf-related inventory typically will have inventory items such as golf clothing and golf equipment. As technology advances the design and performance of the next generation of drivers, the older models become less marketable and decline in value. Suppose that in the current year Ping introduces the Mega Driver 2 and the new and improved version of the Mega Driver. So here are some amounts related to Golf USA's inventory at the end of the year. So we've got shirts, the quantity is 35, cost of 60, net realizable value 70. The Mega Driver, 15, cost is 360, net realizable value is 250. The Mega Driver 2, the new improved driver, quantity is 30, our cost is 350, and the net realizable value is 420. We're supposed to calculate the ending inventory using the lower of cost and net realizable value, record any necessary adjustments to inventory, and explain the impact on the financial statements. So basically, to write down the inventory, we are going to show an adjustment down to net realizable value for the Mega Drivers. The lower of cost versus net realizable value for the shirts, it's cost. For the Mega Driver, it's the net realizable value for 250, and the Mega Driver 2 is cost. So we take the shirts, 35 at 60 gives us our 2100. We have the Mega Driver, 15 at 250 gives us our 3750, and the Mega Driver 2, 30 at 350 gives us 10,500. So our ending inventory is 16,350. Now if we go back and look on the previous slide, you see that the Mega Driver cost was 15 at 360. We're having to write those down because the net realizable value is $90 less per item. So we need to take, excuse me, I said 90, I think it's 110. Yep, 110 from 250 to 360. So we need to write down those 15 units at 110, or debit our cost of goods sold 1650, credit our inventory for 1650. So writing down the inventory has the effect of reducing total assets, increasing expenses, which ultimately then decreases our net income and decreases our retained earnings. Next, we're going to analyze management of inventory using the inventory turnover ratio and gross profit ratio. The inventory turnover ratio shows the number of times the firm sells its average inventory balance during a reporting period. It is calculated as cost of goods sold divided by average inventory. The amount for cost of goods sold is obtained from the current period's income statement. Average inventory equals the average of inventory reported in the periods and this period's and last period's balance sheets. The more frequently a business is able to sell or turn over its average inventory balance, the less the company needs to invest in inventory for a given level of sales. Other things equal, a higher ratio indicates greater effectiveness of a company in managing its inventory investment. Average days in inventory is another measure of how frequently a business is able to sell its average inventory balance. This ratio indicates the approximate number of days the average inventory is held. It is calculated as 365 days divided by the inventory turnover ratio. This is an example of Best Buy and Tiffany's inventory ratios. Best Buy sells a large volume of commonly purchased products. In contrast, Tiffany's is a specialty retailer of luxury jewelry and watches and other accessories. The turnover ratio is much higher for Best Buy. On average, each dollar of inventory is sold in 62 days. In contrast, each dollar of inventory at Tiffany's is sold every 521 days. If the two companies had the same business strategies, this would indicate that Best Buy is better at managing inventory. But in this case, the difference in inventory turnover relates to the products that these companies sell. Best Buy sells mostly common household electronics and accessories, while Tiffany has really expensive jewelry that takes time to sell to the right customer. Shortly, we'll see that Tiffany's offsets its low inventory turnover with a much higher profit margin. Let's check your understanding here. Net sales are $100,000 and cost of goods sold is $70,000. Inventory balances for the past 2 years are $10,000 and $20,000. What is the inventory turnover? So the inventory turnover will be computed as $70,000 divided by the average of $10,000 plus $20,000 divided by 2, which would amount to 4.67 times per year. Another important indicator of the company's successful management of inventory is the gross profit ratio. It measures the amount by which the sales price of inventory exceeds its cost per dollar of sales. We calculate the gross profit ratio as gross profit divided by net sales. Net sales equals total sales revenue less sales discounts, returns, and allowances. The higher the gross profit ratio, the higher is the markup a company is able to achieve on its inventory. So this slide shows the gross profit ratio for Best Buy and for Tiffany's. For Best Buy, that means that for every dollar of net sales, the company spends 78 cents on inventory, resulting in a gross profit of 22 cents. In contrast, the gross profit ratio for Tiffany's is 60%. We saw earlier that Tiffany's inventory turnover is much lower than that of Best Buy, but we see now that Tiffany makes up for that lower turnover with a much higher gross profit margin. The inventory turnover ratio indicates the number of times the firm sells or turns over its average inventory balance during a reporting period. The gross profit ratio measures the amount by which the sale of inventory exceeds its cost per dollar of sales. Let's look at exercise 615. Lewis Incorporated and Clark Enterprises report the following amounts for the year. So we've got the beginning inventory, the ending inventory, purchases, and purchase returns. We're going to calculate the cost of goods sold for each company, calculate the inventory turnover ratio for each company, calculate the average days in inventory for each company, and explain which company seems to be managing its inventory most efficiently. So, the cost of goods sold, we start with the beginning inventory, we add our purchases, we subtract purchase returns, which then gives us our cost of goods available for sale, less our ending inventory then gives us our cost of goods sold. So as you see with Lewis, we start with $24,000, we add purchases of $261,000, subtract the returns of $15,000, gives us our available for sale of $270, minus our ending inventory gives us $252,000 of cost of goods sold. We come up with our inventory turnover ratio by our cost of goods sold, which is the $252, we start with our beginning inventory and our ending inventory. We add those, divide it by 2 to come up with an average. So our 24,000 beginning inventory plus our 18,000 ending inventory, add those, divide it by 2. We take that, the 252 cost of goods sold divided by that average equals 12 times the inventory is turned over. Now with Clark, we're going to follow it the same way. We start with 50,000, add our purchases, subtract our returns, allows us the cost available for sale of 225, minus our ending inventory of 60, gives us our cost of goods sold of 165. That cost of goods sold divided by the average inventory, which is the 50 plus the 60, divide that by 2. We take the 165, divide that by the average, gives us 3 times the turnover. Now the average days in inventory, if we take 365 divided by 12, it means Lewis's are in inventory for an average of 30.4 days. Clark is in inventory an average of 121.7 days. So it looks as though Lewis is managing its inventory the most efficiently because it's being turned over 12 times versus Clark's 3 times. Next, we're going to look at the periodic system. Now, the periodic inventory system does not continually modify inventory amounts. It just periodically adjusts for purchases and sales of inventory at the end of a reporting period based on a physical count. Let's look at the inventory transactions of Mario's Game Shop from January 1st through December 31st to understand how they are recorded under the periodic inventory method. Here you see how the purchase and the sale are recorded under both inventory systems. Under the Perpetual system, we record the purchase of inventory by debiting inventory, while under the periodic system, we debit a temporary account, purchases. At the end of the period, we'll close this temporary account. Sales revenues recorded the same under both methods. However, under the periodic system, we don't record the reduction in inventory or the increase in cost of goods sold at the time of the sale. Instead, we record it at the end of the period. Here you're going to see how the payment of freight in, payment of an account on credit within the discount period, and purchase returns are recorded under both of the inventory systems. Under the periodic system, we record freight charges, purchase discounts, and purchase returns to temporary accounts. We'll close these accounts at the end of the year. Under the Perpetual system, each of these items was recorded directly to the inventory account at the time they occurred. A period end adjustment is needed under the periodic system. It adjusts the balance of inventory to its proper ending balance, records the cost of goods sold for the period to match inventory costs with the related sales revenue, and it closes or zeroes out the temporary purchases accounts such as purchases, freight in, purchase discounts, and purchase returns. The periodic system and Perpetual system will always produce the same amounts for cost of goods sold and therefore also ending inventory when the FIFO method's used. When using LIFO or weighted average, the amounts for cost of goods sold may differ between the two systems, but we'll leave this to more advanced accounting classes. So we've got a question here. When a periodic inventory system and the FIFO method are used, which is correct? The inventory account will be continually updated. The amount of cost of goods sold will be the same under a perpetual system and the FIFO method. The cost of goods sold account will be debited for the cost of each sale made. Or D, the amount of ending inventory will be larger under a perpetual system and the FIFO method. Well, it looks like the amount of cost of goods sold will be the same under perpetual and FIFO. They'll always produce the same amount for cost of goods sold. Now let's look at exercise 619 as we go through some transactions. We've got various transactions in August. We want to record the transactions using a periodic inventory system. And we record the period end adjustment to cost of goods on August 31st, assuming the company has no beginning inventory and ending inventory has a cost of $2,859.50. So this is not perpetual, this is using the periodic system. So as you see, the purchases of the handheld devices, instead of adding it to inventory under the periodic, we are going to debit purchases for $14,000, credit our accounts payable for $14,000. Our August 7th showing the freight in, we debit freight in, credit cash. August 10th for purchase returns, we debit accounts payable and we credit purchase returns for $1,200. On August 14th, when we receive the money with the discount, we will debit accounts payable for $12,800, credit our purchase discounts for $128, and credit cash for $12,672. When we sell more inventory, we debit accounts receivable for $11 and credit our sales revenue. Record the period end adjustments to cost of goods sold, assuming the company has no beginning inventory and ending inventory has a cost of $2859.50. So we'll debit our ending inventory, $2859.50. We'll debit our cost of goods sold of $10,212.50. We'll debit our purchase returns of $1,200, and we'll debit our purchase discounts of $128. We'll credit our purchases of $14,000 and credit our freight in of $400. So basically what this does is it creates our period end adjustments. Finally, we're going to look at determining the financial statement effects on inventory errors. Errors can unknowingly occur in inventory amounts if there are mistakes in a physical count of inventory or in the pricing of inventory quantities. To understand the effects of an inventory on the financial statements, let's think about how cost of goods sold is calculated. An error in calculating ending inventory, which is an asset on the balance sheet, causes an error in calculating cost of goods sold, which is an expense in the income statement. If costs of goods sold is misstated, gross profit's going to be misstated as well, but in the opposite direction. This is true because gross profit equals sales minus the cost of goods sold. To understand the effects of a current year inventory error on financial statements in the following year, remember that the amount of ending inventory this year is the amount of beginning inventory next year. An error in ending inventory this year will create an error in beginning inventory for next year. To understand the effects of a current year inventory error on financial statements in the following year, remember that the amount of ending inventory this year is the amount of beginning inventory next year. An error in ending inventory this year will create an error in beginning inventory next year. Remember, in the current year, inventory errors affect the amount reported for inventory and retained earnings in the balance sheet, and amounts reported for cost of goods sold and gross profit in the income statement. At the end of the following year, the error has no effect on ending inventory or retained earnings, but reverses for cost of goods sold and gross profit. So let's look at one last question here. An inventory error that understates the amount of inventory will result in which of the following in the current year? Well, if it understates the amount of ending inventory, it's going to be overstating the amount of cost of goods sold. So an understatement of ending inventory leads to higher overstated cost of goods sold, an understatement of net income, and an understatement of assets in the year the error is made. Well, that does it for Chapter 6. Make sure you take a look at all of the exercises that are posted in this chapter to really gain understanding in the material. For the entire year,